some of the current concerns that surrounding the whole AI narrative. And again, every time AI stocks dip, it's the end of AI and AI is a failure. And I remember everybody saying the same thing about the internet, right? The internet's just a fad, right? So nobody's ever going to use the internet. Well, here we are. But we saw companies like Oracle take on a lot of debt. We've seen Meta take on some debt, do a lot of CapEx expenditure, Microsoft, Amazon, Google, all the same way, lots of CapEx, hyperscalers. This is now kind of surfaced and some of the concerns over some of the issues with private credit, Blue Owl and some of the other private credit companies suddenly having to gate investors. Are these concerns that are happening around, say, Oracle's debt, are these valid concerns? Are these things we should really look into much more cautiously? Or do you think this is something that is going to pass and will eventually move forward?
Some of the neo clouds, these newer companies that have sprouted up that are providing cloud services to help facilitate the compute and the AI revolution, as newer companies, their credit rating tends to be a little bit lower versus if you look at the big four, your Meta, Google, Microsoft, Amazon, they're AAA, AA credit rated, and they actually have a negative net debt, which means their net debt compared to their EBITDA and their revenue just exceeds it massively versus the neo clouds where they do have substantive net debt. So I think it's important to bifurcate those two and not conflate them, if you will. So I think that's number one. Number two, when I think of funding sources, really feel comfortable that we're in boom versus bubble phase, and it is the funding sources. And today, still the bulk of the funding, particularly from the hyperscalers, which makes up the lion's share, is coming from cash and free cash flow. Our team's thesis is that they will spend basically up to their free cash flow because they view not investing enough as an existential threat to their business, their moat, their competitiveness, and their business ultimate survival, because they view AI as kind of the bedrock foundation of the future economy. Now, if some of these really, really high quality companies do take on some level of debt, a turn or two of leverage, we still think that's okay. This has been a very debt averse industry, tech, for quite some time. Now it's becoming a more capital intensive industry when historically it was capital light. I do think there's some runway for some of these companies to take on some level of debt, particularly given how healthy the balance sheets are and how low the debt levels are today. But I do want to continue to monitor the funding sources across kind of the AI landscape to make sure that they continue to stay high quality. However, when we talk about some of the neo clouds, that's a different story compared to some of the hyperscalers that I was talking about, where there should be a higher level of discernment around the debt that's being taken up by those companies.
Watch the full interview by clicking on the link below.